Welcome to the Investor Bunny Show, your go-to podcast for smart investing and financial freedom. Let's dive in. Today, we're tackling a core question for building wealth. What's a company really worth?
Exactly. And for you listening in, whether you're just starting your investment journey or you've got some experience under your belt, understanding how to value a company is, well, absolutely crucial. We've pulled together some great resources that look at this from different angles, and our goal today is to make these concepts clear and, useful for you.
Think of this deep dive as your shortcut to understanding how investors think about value. We'll break down the main approaches without getting bogged down in overly complex jargon. Our mission is simple: to equip you with a solid foundation for figuring out what makes a company tick and what that might mean for its stock price.
So let's get right to it. When it comes to putting a value on a company, there are generally two main schools of thought. Absolute valuation, which tries to determine a company's intrinsic worth, and relative valuation, which looks at how the market is pricing similar companies.
Okay, absolute versus relative. Let's start with absolute. What's the core idea there?
The fundamental idea behind absolute valuation is to look inward at the company itself. We're trying to determine its inherent value based on its financial health and its potential to generate cash in the future, without directly comparing it to other companies in the same industry.
That makes sense. So it's like figuring out the value of something based on its own merits, not by, comparing it to its neighbors. Can you give us an analogy to really nail this down?
Sure. Imagine you're trying to figure out the value of a unique antique. With absolute valuation, you'd focus on things like the materials it's made of, its historical significance, its condition, and perhaps its potential future auction value based on trends for similar items. You're really digging into the specifics of that piece.
Got it. So what's the main way investors actually do this absolute valuation?
The most widely used tool is called discounted cash flow analysis, or DCF. Now, that might sound a bit intimidating, but the core principle is actually pretty straightforward. It all boils down to the idea that money you receive today is worth more than the same amount of money you expect to receive in the future.
Because you could invest that money today and potentially earn a return on it, right?
Exactly. DCF analysis takes all the future cash flows a company is expected to generate and, discounts them back to their present-day value to account for this time value of money.
Okay, so it's like saying, what are all the future dollars this company is projected to bring in, and what are those future dollars worth if we had them in our hands today?
Precisely. And to do this, we need to estimate a few key things. The first is the company's future free cash flow.
Free cash flow, we hear that term a lot. What's the easiest way to think about it?
Think of free cash flow as the cash a company generates that's truly available to its investors, both the folks who own the stock and those who hold its debt after the company has covered all its operating expenses and made the necessary investments to maintain and grow the business. More free cash flow generally means a healthier company with more options.
Options like paying down debt, investing in new projects, or even paying dividends to shareholders. So how do we actually get to that free cash flow number?
Well, you typically start with the company's net income. That's their profit after all the bills and taxes are paid. But net income includes some non-cash charges, like depreciation.
Depreciation, what's that about?
Think of it like this. If a company buys a big piece of equipment that will last for 10 years, they don't expense the entire cost in year one. Instead, they spread that cost out over the 10 years. That's depreciation. It reduces their reported profit, but it's not actual cash leaving the company in that year. The cash went out when they bought the equipment, you see. So to get a clearer picture of the cash flow, we add those non-cash charges back to net income.
Okay, that makes sense. We're trying to see the actual cash the business is generating. What's the next step?
Next, we look at changes in working capital. Now, working capital is essentially the difference between a company's short-term assets, like inventory and accounts receivable money owed to them, and its short-term liabilities, like accounts payable money they owe to others. If a company's working capital increases, it often means they've had to invest more cash in these short-term operational needs, which, reduces their free cash flow. If it decreases, that frees up cash.
So if they have to buy a lot more inventory, that's cash going out, even if they haven't sold it yet. Got it. And finally, what do we need to account for to get to free cash flow?
We need to subtract capital expenditures, or CapEx. These are the investments the company makes in things like new factories, equipment upgrades, anything that's going to help them operate and grow in the future. That's real cash going out the door, so it needs to be subtracted.
Okay, so we've got our estimated future free cash flows. Now we need to discount them back to today's value. What weight do we use for that?
The standard rate used is the weighted average cost of capital, or WACC. This represents the overall cost for the company to finance its operations, considering both the cost of its debt and the cost of its equity.
Cost of debt is pretty straightforward. That's the interest they pay on loans. But what about the cost of equity?
The cost of equity is essentially the return that investors expect to receive for taking on the risk of owning the company's stock. It's often estimated using a model called the Capital Asset Pricing Model, or CAPM, which looks at the overall market risk and the company's specific risk.
And WACC blends those two together, the cost of debt and the cost of equity based on how the company is financed.
Exactly. The formula looks a bit like alphabet soup, but the key is that it weighs the cost of each type of financing by its proportion in the company's capital structure. The interest on debt is also usually tax-deductible, which is factored in. A higher WACC generally reflects a riskier company or a higher opportunity cost for investors.
So that WACC is our discount rate. We use it to bring those future free cash flows back to their present value. Now, what about the value of the company beyond our forecast period? I think you mentioned something called terminal value earlier.
That's a crucial point. We typically can't forecast cash flows accurately forever. So the terminal value attempts to capture the value of all the cash flows a company is expected to generate after our explicit forecast period, usually the next 5 to 10 years.
So it's like saying, we can predict the next decade, but what about all the value that comes after that?
Precisely. There are a couple of main ways to estimate this. One, the Gordon growth model assumes the company's cash flows will grow at a steady, sustainable rate forever. The formula uses the last forecasted free cash flow, the discount rate, and that long-term growth rate. You'd want to base that growth rate on something reasonable, like the long-term growth rate of the economy or maybe the industry.
Perpetual growth sounds a bit optimistic, doesn't it? What's the other way to estimate terminal value?
The other common approach is the exit multiple approach. Here, you estimate what the company might be worth at the end of your forecast period by applying a typical industry multiple, like the ratio of enterprise value to EBITDA, to the company's projected earnings in that final year. You'd look at the multiples of similar established companies to get a benchmark. Some analysts even take an average of the terminal values calculated using both methods, actually.
Okay, so we've got our future free cash flows, our discount rate, the WACC, and our estimated terminal value. Now we actually do the math. We discount each of those future cash flows, including the terminal value, back to today.
Exactly. For each year in your forecast, you'd use the discount rate to calculate the present value of that year's free cash flow. The further out the cash flow, the more it gets discounted, You do the same for the terminal value, discounting it back to the present.
And then what? We just add all those present values together.
That's right. The sum of the present values of all the future free cash flows plus the present value of the terminal value gives you the enterprise value of the entire company.
Enterprise value, is that the final number we're looking for as an investor?
Not quite. Enterprise value represents the value of the entire business to all its stakeholders, debt holders included. As a stock investor, you're primarily interested in the value of the equity. To get to the intrinsic value per share, you need to subtract the company's net debt from the enterprise value to get the total equity value. Then you divide that equity value by the total number of outstanding shares.
Okay, so after all that, we have an estimated intrinsic value per share. How do we use that?
Well, the main idea is to compare this intrinsic value to the company's current stock price in the market. If your calculated intrinsic value is significantly higher than the market price, it might suggest the stock is undervalued and could be a good investment opportunity. Like, one of the sources had an example where a stock was trading at $370, but the analysis suggested an intrinsic value over $450. That hints at a potential buy.
That's the big payoff. But it sounds like this whole process is very sensitive to all the assumptions we make about the future.
Absolutely. That's one of the biggest limitations of absolute valuation. Predicting future cash flows, especially over many years, and choosing the right discount rate are challenging and involve a good deal of estimation, maybe even some guesswork. Even small changes in these assumptions can have a really significant impact on the final intrinsic value. It's more of an art than a perfect science,
So, while absolute valuation tries to give us a fundamental true value, it's heavily reliant on our forecasts. That brings us to the second main approach. Relative valuation. How does that work?
Relative valuation takes a different tack. Instead of looking solely at the company's own fundamentals and future projections, it determines a company's value by comparing it to the market values of similar companies, its peers, or to industry averages. It's all about seeing how the market is currently pricing comparable businesses.
So we're looking at what other similar companies are selling for to get a sense of what our target company might be worth.
Precisely. This method uses readily available market data, like stock prices and financial statement information, to calculate various ratios and multiples. We then compare these for our target company against those of its peers.
What are some of the key ratios and multiples we're talking about here?
There are several popular ones. The price-to-earnings ratio, or PE, is very common. It's simply the company's stock price divided by its earnings per share. A higher PE could suggest investors are willing to pay more for each dollar of earnings compared to similar companies.
Makes sense. What else?
We also have the price-to-book ratio, PB, which compares the stock price to the company's book value per share. The price-to-sales ratio, PS, is useful, especially for companies that aren't yet profitable, as it compares the start price to the revenue per share. Then there's price-to-free cash flow, comparing stock price to free cash flow per share. And finally, enterprise value multiples like EBITDA or EV revenue look at the total company value relative to its earnings or revenue.
So we calculate these ratios for the company we're analyzing and then see how they stack up against its competitors.
Exactly. For example, if the average PE ratio for companies in a particular industry is 20, and the company you're looking at has a PE of 25, it might be considered relatively overvalued compared to its peers, assuming all else is equal.
The big if there being assuming all else is equal. How do we know we're comparing apples to apples? What makes a company a true peer?
That's a critical question. It's really important to select truly comparable companies. Ideally, these should be in the same industry, have similar business models, be of a similar size market capitalization, and operate in the same or very similar markets. Comparing Walmart to other large retailers like Amazon, Target, and Costco is a good example of looking at peers.
What's the underlying assumption when we use relative valuation? Why do we expect similar companies to trade at similar multiples?
Well, the core assumption is that companies in the same industry are likely to have similar risk profiles, growth prospects, and cost structures over the long run. Therefore, the market should, in theory, value their earnings, revenues, or cash flows in a similar way.
But are there any limitations to this approach? It feels like it's only telling us how a company compares, not its absolute worth.
You've hit on a key limitation. Relative valuation only tells you if a company is expensive or cheap relative to its peers. It doesn't tell you if the entire industry is overvalued or undervalued by the market as a whole. If all the comparable companies are trading at inflated prices, your undervalued pick might still be too expensive in reality. Also, finding truly identical companies is virtually impossible. Differences in management, brand strength, or even geographical focus can justify different valuations. And, like absolute valuation, relative valuation often relies on historical data, which may not always be indicative of future performance. Market sentiment can also play a big role in driving multiples up or down,
So neither absolute nor relative valuation is perfect on its own. That brings us to the question, which approach should investors like us be using?
Yeah, the consistent message seems to be that the most effective way to approach company valuation is to use a combination of both absolute and relative methods.
That makes sense. Absolute valuation gives us that fundamental intrinsic value based on the company's own expected future performance, while relative valuation gives us a valuable market context by showing us how similar companies are being priced.
Exactly. By using both, you can get a more comprehensive picture. You can see if a company's intrinsic value, as calculated through a DCF, aligns with how the market is currently valuing its peers. If there's a significant divergence, it could signal an opportunity or maybe a potential red flag.
So even though absolute valuation doesn't directly compare a company to its competitors, the intrinsic value we come up with can then be compared to the company's current market price, which is influenced by the trading multiples of those comparable firms.
Precisely. It's about triangulating the value from different perspectives to make, hopefully, more informed investment decisions.
Okay, this has been a fantastic deep dive into company valuation. To recap, we've looked at absolute valuation, focusing on discounted cash flow analysis and estimating a company's intrinsic worth based on its future cash-generating potential. Then we explored relative valuation, where we compare a company's market multiples to those of its peers to see how it stacks up.
And importantly, we've learned that while both methods have their strengths and weaknesses, using them together can provide a much more robust and nuanced understanding of what a company might truly be worth.
Here's a final thought for you to chew on. Consider a rapidly growing tech startup with potentially massive future earnings, but currently little to no profit. Would an absolute valuation approach focusing on those future cash flows be more relevant than trying to compare it to established but perhaps slower growing competitors using current earnings multiples? Conversely, for a mature, stable company in a well-understood industry, might relative valuation offer a quicker and perhaps more reliable gauge of its value? Think about which approach might be more insightful in different investment scenarios.
Some great food for thought. Definitely something to consider.
Thanks for tuning in to the Investor Bunny Show. Subscribe, share, and keep investing wisely. See you next time.